Hello and welcome to ActivTrades News. I'm Leah Milner and today I'm joined by Neal, currency analyst. We're going to be talking about the ongoing fallout from the Brexit and what this means for the Bank of England's monetary policy decision today. So what do you think is going to happen today?
Leah, I think that Governor Mark Carney has essentially cut away his own monetary policy committee's flexibility in the last few days by essentially leading us to a conclusion that they are going to cut. Now, whether that's 25 basis points or 50 basis points, or whether one of those two and accompanied by quantitative easing, I don't know. But it seems to me that Mr. Carney has led us down this path, and if he wants to avoid too much market volatility, the MPC now has to deliver whether or not it's actually justified.
He's signalled very clearly, really, the direction things are heading in.
He's probably signalled it rather too clearly to be able to back away from it now. The question now is whether the rest of the MPC is prepared to go along with that, or whether, we find out that, or Mr. Carney finds out, there is only primus inter pares, first among equals, and he can be outvoted. Nevertheless, given the strength of the message he's given, I would think it unlikely that the majority of the MPC would wish to undermine the governor at this point in time, given that the governor has pointed us down this road, which I guess means that sterling will remain soft for choice. We've had a little rally in the last few days. Let's call it the Theresa May effect, if you want. There's a kind of a calmness out there in the marketplace, but if anybody thinks that the implications of Brexit are over and that the worst days of sterling are behind us, I think they're going to be sorely mistaken in coming weeks.
I mean, do you think there'll be any positive impact from a rate cut? Will it have the effect that Carney hopes for?
Well, there is a reason that we haven't cut from 0.5% for 7 years, and that's because initially the Bank of England was concerned that the building societies, which is a financial institution basically unique to the United Kingdom, couldn't really handle interest rates going much below. But let's just look at it. Let's assume, as Paul Tucker said 3 years ago now, the building societies are in a better position to absorb a lower base rate. What happens if you cut from 0.5 to 0.25? It's already been said that 5 out of 6 mortgage rates will not be impacted.
Right.
Savings rates, they'll be cut because they will. So you're now basically making the returns that the elder savers get less. So are they going to be more or less inclined to spend money with less returns coming? I suspect they're going to be less inclined. I just wonder whether we're getting into a liquidity trap here where we feel, or the bank feels, it has to be seen to be cutting interest rates, but the effects thereof are negligible. Bottom line is we're not where we are with the economy because of anything the Bank of England's done wrong. We are where we are because of the implications of a political decision that the British people have taken. So I'm not quite sure monetary policy gets us out of the hole.
Absolutely. And what about the pound? How low do you think it could go, really?
Well, we've been down to the 128 level. We've bounced back up to 132. I think it may possibly squeeze a little bit higher to 133, 135 level. But I think above there's going to be plenty of people who are looking to sell this, because once we get the summer months out of the way, and the Eurozone officials, as we've seen in recent years, have an amazing ability to park crises while they go on holiday, only to revisit them in September. It's going to come back, and I think that the line of least resistance for the British government and the Bank of England is to allow the pound to decline. Not as precipitately as it did on the 24th of June, but nevertheless to decline. 125 is the first level. I wouldn't even rule out 120. But if it gets to 120, I think a lot of people around the world will be filling their boots with sterling and ploughing into sterling assets.
Do you think parity with the dollar is a possibility?
No, I don't actually know. I mean, I was around in 1985 as the start of my career when sterling bounced off 105. And that was as a consequence of massive dollar appreciation because the Americans were squeezing the pips out of inflation by raising Fed rates so very high. It seems to me implausible in an era of very low interest rates around the world that even Brexit, if it goes completely wrong and we fall out totally with the European Union, which I don't expect, that would be going down there. But I suspect, as we get 120-ish, this country has a lot of assets that's always up for sale. You know, with Britain, it's an open economy. We don't argue about whether or not you can buy them, we just quibble about the price. And I think a lot of guys in Asia, reserve managers and investors around the world will be seeing sterling down that level, 120, 123, as very, very good demand.
And what about in the US with earnings, the earnings season about to kick off really in earnest? What do you think we're going to see there?
Earnings have been in decline for some quarters now. And ordinarily, you would suggest that that would mean that the equity markets were toppish. And I'm sure a lot of ActivTrades clients who trade equities are looking at this kind of thing. But the bottom line is, where else do you go at the moment? I'm reminded of Chuck Prince, the old Citibank CEO, back in 2007, saying, while the music's still playing, we're still on the dance floor. And the music's still playing because interest rates around the world are derisory. The Bank of Japan is just about to probably bring in more monetary policy easing. The government of Japan is going to bring in new fiscal stimulus. It'd be Abenomics on steroids. There is no reason why people don't want to be in equities at the moment, because the logic is that they're more likely to be higher tomorrow than they were today, even if your heart is telling you that the earnings are saying this is a load of rubbish. Where else do you put your money?
Absolutely. And could you elaborate a little bit more, returning to the pound, on what the realities would be for Britain with an ongoing low pound?
Well, the low pound does generate higher exports over time, assuming there's demand. The latter point is questionable. If economies around the world are going to go into a downturn, well, there's no reason why they need to be stocking up with Scottish shortbread and Scottish whisky and other stuff that we make. But nevertheless, the cheaper the pound is, in theory, the more competitive our product is, although the stuff that comes in from the outside, the components that say we use to make the cars that when we resell, they're becoming more expensive. So it's a balance, but that only clicks in after a period of time. I would be expecting some of the major British exporters to be doing long-term hedges down here against receivables down the road. People like Airbus, who make the wings for the Airbuses in Wales. I would think it'd be incomprehensible that companies of that ilk, called Rolls-Royce PLC, are not looking at locking in sterling down here against stuff that they can see in contracts down the road. And Farnborough's on this weekend, of course. But it takes time for that to click in. And in the short term, you have stuff coming in from the outside. Gasoline is a perfect example here, where the pound today buys far less petrol than it did last week. So the gasoline price starts to pick up. And it was interesting, there was a piece in the Times yesterday who defined this as the cheaper pound makes exports cheaper, therefore we sell more. But essentially what it means is the British worker works harder in the short term to make things, to sell to foreign people who get things cheaper, and that same British worker is then having to pay more to fill up his car. So yes, it's a quick fix, but it's a traditional fix in this country, going back to Harold Wilson in 1967, 1992 after we pulled out the ERM, and it is essentially the benefit of keeping your own currency. And I would respectfully suggest that Matteo Renzi in Italy wishes he could devalue the lira, but he can't.
I suppose it's going to be quite painful then for UK consumers, though.
Yeah, we buy more from outside than we sell, and we have a lot of imports. So there is an argument here that it ends up, if the less affluent part of the community voted for leave, which is the implication from some of the cephalological analysis, they're going to be somewhat worse off because the stuff they buy at the supermarket is going to go up in price. Equally, if monetary policy is eased to such an extent that it does bear down on mortgages, all it does is means that the people who are saving up for a deposit for a house are going to get less interest on their deposit, so it's going to take them even longer to be able to afford to buy a house. Lower mortgage rates will encourage people who have money to pile back in, so pushing up the price of houses, so making them even less achievable for people. And those who are renting are going to find that the rents are going up because as prices go up in the shops, landlords put rents up as well. So, it's no panacea, what's happening, but it is a logical consequence of a political decision that the British people took, and that decision was taken with all this having been laid out before them. So there shouldn't be buyer's remorse here. We all knew what was going to happen, or we should have known what would be the consequences of a Brexit vote.
Mm-hmm. And what about EU policymakers and dealing with some of the issues around the Italian banks and things? What would be top of their minds at the moment?
Well, Matteo Renzi's got a big problem, hasn't he? I mean, the total gross impaired loans in the Italian banking system are 360 billion euros. A couple of years ago, the European Union brought in a system for supporting banks, which included the bail-in, so that people who own bank debt, they take a hit. The problem Renzi's got is that the Italian public have been large buyers of Italian bank debt in the last few years. So if you apply European Union rules in the way they're meant to be applied, because you have to bail out some of the banks, you have to bail in some of the creditors, which means you're going to be taking money off the average Joe who's invested in this paper, and then he's not going to vote for Renzi in the constitutional referendum, which is coming in October, and the Italian government will fall. And many people within the European like Mr. Renzi, because at least he's tried to bring in some reforms, and the alternative at the moment is the Five-Star Movement, which is decidedly anti-EU. So I think the European Union is in a quandary here. On the one hand, they don't want to set a precedent, and on the other hand, they can't afford to let Renzi go. But what they will do is try and park it through the summer and come back to it in September, because they don't want to spoil their holidays. As regards the European Union dealing with the United Kingdom, I think that's going to be interesting, because I think Theresa May has basically got to show what she's made of in the coming months. She's got a very slim parliamentary majority anyway. Domestic situation is assisted by the chaos within the Labour Party, but she will have to stand up against the Europeans and point out to the fact that if we don't come to a reasonable accommodation between the United Kingdom and the European Union, they stand to lose probably more than we do, because we've already taken the hit. Mm-hmm. If they want to play hardball over the rules, okay, fine, then bring in the tariffs. Okay, so we can't sell our Scottish whiskey, but you ain't going to sell your German cars. So that becomes a problem for the Germans, and I suspect all this gets sorted out, because there's two things that matter in this. One is money, because money always matters, and secondly is defence. And the United Kingdom punches above its weight in European defence, and there's a trade-off to be made. Yeah. We will get a deal. Brexit will work. It's not going to be pretty along the way. There's going to be ups and downs. I think the temporary stability that we're seeing in sterling and the euro is that, just temporary. I won't be buying the pound, and I certainly won't be buying the euro anytime soon, personally.
What will you be buying?
I think I think the dollar at the moment is king, if only because you haven't got much choice. Where else do you go? The Japanese, since the weekend, it's quite clear that the yen safe haven trade has been taken off and people have been hurt. If I'm right about Abenomics on steroids, then that will underpin a weaker yen. We're about 104, 105 this morning. 110, 115, be great for Japanese exporters. It will also tie in with the fact that the Chinese have been quietly devaluing, weakening the yuan against major currencies, all through Brexit, by the way, and predominantly against the US dollar. A stronger dollar does the Fed's tightening for it, and therefore pushes back the need for the Federal Reserve to actually do something, even if they so wished. And against the euro, well, as I say, if the pound's in trouble, I don't see why we should dissociate the euro from that. We're all in this together, whether we like it or not. And I think, essentially, the flows into the US bond market, the short-term flows into the US equity market are telling me that, notwithstanding everything else that's going on in the world, right here, right now, investors prefer the dollar. And frankly, I don't blame them.
Fantastic. Well, thank you very much for your time. Thanks for joining us for this week's ActivTrades news. Please join us again next week, when no doubt we'll have far more Brexit fallout to report on. Many thanks.